Good morning, traders and investors. My name is Roger Scott, and welcome to 2023. It's January 3rd. I think today's a Tuesday, best of my knowledge. Now, folks, we're just gearing up here. I want 2023 to be the best year of your trading career ever. I want this to be a year of happiness for you, a year of health, and I want to wish you nothing but the best. Now, let's get started. The market's gearing up to open about an hour and 28 minutes. Actually, sorry about that. No, it's already 8:30. The market's going to open up in 58 minutes. And as you can see here, the Dow's up about 145. The Nasdaq is up pretty good. And the S&P's lagging behind, probably because energies are a little bit low this morning at the start of the day. So things are just not looking all that great, as you can see right here. One thing I want to warn you about, and this is really, really important. Now, I know it's the beginning of the year. I know you're expecting the stock market to gear up, but here's the truth of the matter. People still take vacations. The market is not going to be fully integrated, if you will, till the next week. All right. So there's still going to be a lot of things happening this week. A lot of people are coming back. There's a lot of flights delayed. A lot of people are like my wife is in Colorado skiing with my daughter. There's a lot of stuff going on right now. So don't expect the market to just snap your fingers and expect the market to start trading normally again. Keep your eye on the bond market because the bond market is infinitely bigger than the stock market. So at least it offers us some non-random action. But with that said, and with the warning behind me, we have something tomorrow. We have the FOMC minutes, which is important because we'll get a chance to hear what the Fed is thinking the last time they raised rates earlier 2 weeks ago. Then on Thursday, we've got international trades and goods and services. We've got jobless claims. And Friday, and I'm hoping by Friday, things will start picking up. Liquidity will almost be normal back again. We've got factory orders, employment situation, and the ISM manufacturing index. Most of the beginning of the year is going to be focused on how well the Dow does the first week. There's a lot of back tests and studies that show how the Dow does the first and the broad market does the first week of the year. And I'll give you more details on this study. Will impact the rest of the year, which there's a lot of truth to that, but there's a few caveats, and I want to go through that with you as well, and I'll do that in my VIP room today. But looking at the bond market, it looks like we're gapping a little higher. Don't be surprised if we lose this and come off because I think the Fed is going to continue doing exactly what they've been doing, and interest rates are not going to be off. They're not going to be lower. They're going to be going higher, not lower. Now, looking at individual sectors, industrial is finally leading, believe it or not. Healthcare is the second, and energy is number 3, but you still have financial and consumer staples. Now, a lot of people think financials are going to go up because interest rates are going higher. Financial companies don't make their money on higher rates. They make money on the spread because they still have to pay the Fed fund rate. So it's a matter of volume. Volume usually increases when there's less fear of a recession, which is not the case right now. So I'm not as bullish on the financial sector as a lot of other traders, but I'm really loving consumer staples. So industrial, healthcare, energy, and financial consumer staples would be the main focus, and I would be staying away or fading technology, real estate, communication services, and consumer discretionary stocks, much like we've been doing last year. Now, I want to let the market set a tone for the year. As I said, usually the first week or two of the year, the market sets a tone. I want to see if January is going to be a really strong month or not. But right now, you've got 72 stocks making 20-day breakouts, and only 28 stocks making 20-day breakouts, 1-month highs. Now, I look at these very, very cautiously because these have a big impact on what happens to the market. But if you look at it, most of these stocks that are making 20-day breakouts are Halliburton, Baker Hughes. There's just not a lot of volatility. Gold stocks, some ETNs, healthcare stocks. But the bottom line is the market is fairly stagnant right now, and there's just not a lot of places for it to go. Let me go past the pre-market brief, kind of tell you what the markets are expecting, and we'll go from there. Actually, I didn't even highlight it this morning. How dare I? But I'll do it at the same time with you. So market participants for the new year were concerned over potential recession in the U.S. and Federal Reserve monetary tightening policy. Big news. S&P lost 19.4% for the year. NASDAQ tumbled 33%. That's huge. And typically when NASDAQ goes 30, 40% down, that's really all there is to it. There's just not much more to go, which is why I'm not expecting the market to really go down much, but I'm expecting a lot of consolidation. The Dow posted 8.7% fall for 2022, not the worst, but booking their biggest percentage declines since 2008 crisis. Can't make that up if you tried. Investor sentiment was also dulled after the International Monetary Fund director said on Sunday that United States, Europe, and China were all slowing simultaneously. And if China gets involved, if COVID and China COVID, I'm saying that interchangeably, gets involved in all that, it's not going to be good. She said that at least a third of the world faces a potential recession this year amid high inflation and rising rates. Now, in the coming week, that's this week here, we've got FOMC minutes, ISM manufacturing, employment data, crude oil inventories, unemployment numbers, factory orders, a lot of stuff. And again, remember, the market is still fragmented. There's still not a lot of stuff on the table. Today, all eyes are focusing on the U.S. manufacturing readings. They're forecasting the number to be at 46.2 compared to 47.7. In Europe, we've got to talk about Europe. Stocks are up this morning as participants return from the holiday and assessed economic outlook. Investors have been closely watching China reopening for the resurgence of the COVID infections. Big deal. European Central Bank President Christine Lagarde said on Monday that wages in Eurozone were growing faster than earlier expected, and central banks must prevent this from adding to already high inflation. Oh boy, most Asian markets today settled in the green. Chinese Shanghai closed up less than a point, while Japanese markets were closed for the holiday. China's Shanghai Composite closed higher as market participants weighted the near-term challenges of the COVID-19 infections in the country against the longer-term benefits of a full reopening. They should have been doing that a few years back. Also, recent data revealed Chinese manufacturing shrank for a fifth consecutive month in December. That's very negative, because if their manufacturing is shrinking, that means our demand is shrinking. It's really simple. China is entering the most dangerous week of the pandemic. Oh boy, not good. As far as stocks in play, Tesla's down about 4% pre-opening. Really important. NIO stock is up about 4% pre-opening. In terms of earnings, let's see here, NFL. I'm not seeing any major earnings, so we don't have earnings really messing with us, but we do have Tesla and NIO stock and Lee. So you've got two car companies. Lee's up 7% and NIO is up 4% pre-market. And again, Tesla's down 4%, and Tesla's been one of the most beaten stocks this year. Now, as I mentioned, the markets right now are gearing up for some volatility. Now, if you look at the broad market, which we'll do right now, you will see that we're right now coming off a consolidation. Now, the question is, are we going to go up on this consolidation, or are we going to go flat down? If you look at the market the last few weeks, look at this, just nothing here. So I want to see whether it breaks out to the upside or downside, because it can stay here for the remainder of the week. Now, if you look at the QQQ, which tracks the largest 100 NASDAQ stocks, they've really been beaten down. This looks like it's bottoming out, and it looks like it's starting to head a little bit higher, which is very positive. But again, we're in a very bearish sentiment, and the long-term trend, that's the 200-day moving average, is still bearish. So be careful of how much upside we're going to get here. I'm very cautious on that. And looking at the S&P, that's meeting us in between. Again, you've got upside, but again, till we clear the 387 level, this is just noise. And it's been going on now for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, almost 2 weeks. It needs to break out one way or the other. And the problem is, if you look at sentiment, if you look at market sentiment, which we'll look at right now, you will see that it's not looking all that great. Look at the S&P 500. 45% of stocks are trading below the 50-day moving average. 200-day, 48%. That's not strength. And most of the indices are starting to get red on the 50-day, and they're starting to lose market cap on the 200-day. Matter of fact, look at this. Consumer staples and energy are above 50 percentile. Consumer discretionary, barely. I don't think that's going to hold up. Industrial, but look at infotech. Look at materials. Look at real estate. look at communication services, and look at utilities. That's not happiness right there. That's not strength. So be very cautious. Looking at the Dow, 46% and 49%, a lot of vulnerability. Russell 1000, the large caps, that's 1,000 large cap stocks, 43%, 42%. And Russell 2000, the small caps, 30 and 35. Now, as I mentioned before, we need to pay attention to ARK funds. Why? Very important, and I talked about this in my Code Breaker class, which I'll be mentioning again in a minute. ARK peaked out February of 2021. The S&P, that's the small cap stocks, the big small cap stocks, the Teslas and all of the stocks that were rising during COVID. S&P peaked out almost a year later, 11 months later, which leads me to believe this ARK fund, which has a lot of tech stocks and a lot of tech, is really bottoming out around here. See that? I mean, yes, it's gone a little lower. Yes, I didn't pick the low in May like I thought I did. It is down by a hair, but notice this. Notice the consolidation. And notice we started this a lot earlier. So what I believe is happening is this consolidation is going to lead into a breakout, which I will not let you guys miss out. But first we have to pass the 200-day moving average to the upside. My point is, this year, you want to keep your eye on these small cap stocks, because if they started to fall earlier, the odds are they're going to start leading higher earlier as well. So we have to keep a we got to keep an eye on these stocks, because usually recessions last, what, about 18 months, 2 years? Well, it's been going down since beginning of 2021, and we're beginning of 2023 right now. You see what I'm saying? So maybe another 6 months to go. Bottom line is, folks, and I want to show you another thing. This is the entire momentum levels for all the stocks. Here we go. So above $2, these are stocks trading above $2. Only 38% of stocks are above the $2 level, are above the 200-day moving average, and 50-day the same. What's good is at least the 50-day and the 200-day are a lot more on the same page than they were a while back. So that's really, really important. But you see, like when you have 80% of stocks above the 50-day moving average, like utilities, and you have 30% above the 200-day moving average, that's not warm and fuzzy. This number here is supposed to be higher. All in all, I think the market is going to start moving. I think this week we still have a lot of consolidation, a lot of uncertainty, but I think we're going to see some more directional bias next week. Keep your eye on the Dow Jones and how it did. And remember, small caps, small caps. This is going to be a year of small caps. And speaking of small caps, I want to tell you something interesting. If you haven't heard yet, I've cracked the code on one market pattern that boasts a 100% win rate on 146 stocks over 5 years. And this was over 5 years, not over 5 days, okay? Now, that, of course, based on historic returns. Don't get too excited. There's no way to know how it will do in the future, but I'm very excited about it. And so far, from what I've seen, it looks really, really solid. Because even if we don't get a 100% rate going forward, let's say we get 80, 85, that's amazing. That's a huge, huge upside. So there's no way to know how it will do in the future. I got to be honest with you. But the name of the pattern, it's called the shooting star. And once you spot it on a daily chart, all you've got to do is enter the position the next morning at the open, or maybe during the day. I give you an alert. It's all there. And then you exit when the daily close is above the previous day's high, end of the day. Very simple. I give you all the information. I find this pattern and a few others do extremely well regardless of what the S&P is doing. You hear what I just said? Regardless of what the S&P is doing. But you don't have to take my word for it. Click on the link below. Get all the details for yourself. And by the way, it's much, much easier to find these patterns than before, thanks to my trading breakthrough, which I will talk about. Follow the link below. You don't want to miss out. 2023 is just getting started. Tomorrow, I'll start getting into individual sectors and giving you support and resistance levels and showing you where momentum is going. Right now, you've only got 28 stocks making 20-day highs and 72, so I wouldn't be holding my breath for a big, big rally. Follow the link below. Start this year on the right track, and I'll talk to you guys later. Bye.